Hello again, everyone. Welcome back to Managerial Accounting. We're going to start off our problem demonstrations today in a pretty logical place. We're going to start off by looking at a picture of a lamb having tea with two ladies. And it's a pretty smart place to start off, right? If you're looking at that photo and you think about everything we've done in managerial accounting, you probably don't see how this ties in, and you're probably looking at that saying that that photo is irrelevant. But if you've read through Chapter 10, you know that Chapter 10 is all about relevant information in making business decisions. So what we're going to do in our problem demonstrations today is we're going to learn how to separate irrelevant things from relevant things and use that relevant information to make business decisions. The three decisions that we're going to look at are going to be asset replacement, whether or not we should replace an asset we are using with a new one. We're also going to look at make versus buy decisions. Should we make a product in-house or should we go out and buy it from somewhere else? And that's also called outsourcing. And then finally, we're going to look at special order decisions, whether or not we should accept a special order from a client. So in order to be able to make any of those three decisions, we have to be able to take relevant information and apply it and then filter out all the irrelevant information. And there's a lot of irrelevant information in business. So that's our goal for today, is to learn how to separate the two types of info and apply the good info to make business decisions. Before we jump in and talk about making business decisions, let's take a look and try to separate relevant cost from irrelevant cost. What we have up here is a problem that's going to kind of teach us how to do that. Take a second to read through that. There's a lot going on there, and then we'll get back together and figure this out. Part A of your problem wants you to identify three alternative courses of action that we could take with regard to the leftover shirts. Alternative number one, we could rework and resell them. That would definitely be an option. Option number two, we could sell them for scrap. And the problem doesn't really point out, but you have to remember in any business decision, an option would always be status quo. We could do nothing. We could leave those t-shirts sitting in a box in our warehouse and just kind of leave it at that. So our three options would be rework them, resell them, sell them for scrap material, or just keep the status quo and just keep them in a box and not do anything. In part B, they want to know what costs are sunk in this decision. Sunk costs are very important, and it's an important concept to understand, and it's one that people kind of get confused on. A sunk cost is simply a cost that we cannot recoup that we've already paid. As such, it has no bearing on our future decisions. We should not consider it at all when trying to make a decision that's going to impact the future. So in this problem, the sunk costs are going to be the amount we already paid for our t-shirts. So the sunk cost is the $11.75 per shirt that we've already paid. That amount has no bearing on our decisions. We've already paid it. The money's already went out the door. So we shouldn't consider that at all when making and deciding between 1 through 3 here. The amount we've already lost or already paid shouldn't have any bearing on it. And you hear that sometimes in sports. If you're a sports fan, a lot of times you'll hear a team say, oh, well, we're paying this outfielder $8 million a year, so he's going to have to play. We've already committed that money to him. We can't find somebody else. Well, that amount you've already paid that outfielder shouldn't matter. If the guy can't hit and he can't field, you should find somebody else. Don't worry about the $8 million you've already spent. It's a sunk cost. Part C, identify the relevant cost of every alternative you listed in A. So what are our relevant costs here? It says for option 1, we could rework at a cost of $5.50 per shirt and then sell at a cost of $10.25 per shirt. So if we go that route, we would have a relevant sell price of $10.25, and we would subtract from that a relevant cost per shirt of $5.50. The difference between that would be a relevant profit of $4.75 per shirt. The other option we had was to sell for scrap. The relevant number in that would be $2.60. It wouldn't cost us anything to do that. We just straight up sell them for scrap, so that would all be profit. Status quo, there really are no relevant costs there. We said the $11.75 was sunk and shouldn't have any bearing on our decision. So those are the only relevant costs that we have in the problem. For part D, they want you to take your answer on C and say the best alternative. Well, alternative number 2 provides me with a profit of $260 per shirt. Alternative number 1 provides me with a profit of $475 per shirt. Alternative number 3 does nothing. So the best deal here and the best decision we could make would be rework and resell at a profit of $475 per shirt. So that's the idea, sorting out irrelevant cost from relevant cost. In our first problem we're going to look at asset replacement. We have an asset that we're using. We're thinking about buying a new one to replace it. Should we go through with it or not? And pretty simple analysis here. We're not getting into discounted cash flows or anything like that. All we're doing is looking at the incremental savings and cost. And all incremental means is how much money are we going to save or are we going to lose by going between the two different alternatives, usually doing nothing and buying a new asset in this case. So we're looking at the incremental savings and the incremental cost, and then we'll make our decision based on that. And read through the problem, get a handle on what we're doing. Topeka Brake Manufacturing, we just bought a new computer-based scheduling software for $480,000. A representative has told us that there's a new version out that's clearly superior to the one we have. The price of our new software that we could buy would be $840,000. That software would save us $32,000 annually in related cost. Both packages ought to last 10 years and they have no salvage value. We can sell our existing software for $356,000 if we buy the new. So the question is, should we keep the old or should we buy the new? To figure that out, we've got to look at the incremental amounts that we will save and the incremental cost that we will incur between the two decisions. So the incremental savings, the problem tells us we will save $32,000 a year. And we would save that amount every year over the life of the software, which would be 10 years. Our incremental savings will be $320,000. The amount we'd save per year times the number of years that we would save it, 10 years. The incremental cost, it says it's going to be $840,000 to buy it. We have to shell out that amount, but we can also sell our existing software for a little bit of money. So we're going to net those two together. The total out-of-pocket cost is going to be the difference between those two. $840,000 minus $356,000. We net those two numbers together and we get $484,000. That is our incremental cost. So if we go the route of buying the new software, we'll save $320,000, but we'll end up spending $484,000. That is a incremental loss of $164,000. Now I don't know what kind of line of business you're in, but in my world we don't buy an asset just to lose $164,000 on the transaction. So in this case I would definitely say we should not proceed with the purchase of the new software, and we should just use the software we've already bought. Now we're going to take a look at a make versus buy decision. We are a manufacturing company, and one of the pieces that we require in our final product, we could either make it in-house or we could buy it from somewhere else. And really we're just trying to figure out what's going to be the cheapest way to do it and still get the same quality piece to use in our final product. So we're looking for relevant cost to manufacture and the relevant cost to buy it from somewhere else. It says we need 120,000 of these things, and we're given the cost to manufacture per unit. And a lot of these are going to be variable. So I'm just going to kind of make a note here. The direct material, the direct labor, and the variable overhead are all going to be variable. And that's an important point to make for this problem. We have a cost per unit to purchase that we've been quoted, and we've got our variable cost, and we have one fixed cost right there. So the question is, should we continue to make this product or should we get it from somewhere else? Part A wants to know, assuming that all our internal production costs are avoidable, if we purchase rather than make the latch, what would be the net annual cost advantage to purchasing the latches? So the idea is all these costs right here if we don't make the latches in-house, are avoidable, meaning that we won't incur the cost. So the relevant cost to manufacture is going to be $4.60 a component. The relevant cost to buy is going to be $4. So the savings would be 60 cents a component. Now, the advantage of buying would be that savings times the number we'd have to buy. We need 120,000 units. We multiply that by the 60-cent savings, and we get a savings of $72,000. Now you look at that, and then right off the bat you say, oh, that's a big savings. We ought to do that. No questions asked. You got to consider a couple of things. First of all, is that supplier going to be stable and be in business and be able to reliably provide us with those 120,000 latches? If the answer is yes, then we probably should go ahead and do that. If the answer is we don't know, maybe it's a newer company, maybe they've had operating problems before and problems getting their product out the door to us, then we might not just blindly take that number just because it's smaller. The main objective here is to manufacture our product and get it out the door. We don't want to do anything that might jeopardize that. So the 72,000 savings look good, but keep in mind there's always other decisions that might come into play there too. We just don't look at the dollar amount and then go from there. Part B says assume that some of our fixed overhead costs could not be avoided if we purchase rather than make the latches. We're going to have to incur those costs anyhow. How much of the fixed overhead must be avoidable for the company to be indifferent as to making or buying the latches? So our fixed costs were $1.12. They want to know how much of that has to be avoidable in order for us to be indifferent, meaning it doesn't matter whether we make them in-house, it doesn't matter if we get them from somewhere else. So $1.12 were our fixed overhead cost. It said our savings were 60 cents. So we're just going to kind of do a little subtraction here. If we take that 60 cents from the $1.12, we get 52 cents per unit. 52 cents would be our minimum avoidable fixed cost, meaning if we are able to avoid 52 cents of fixed cost and our fixed cost remained at 60 cents, then it would be indifferent either way of making or buying. Finally, we're going to take a look at a special order decision. Should we or should we not accept a special order from a client? A lot of times a client might send in a rush job or some kind of job that requires a specific way of doing the order, and we have to decide whether or not we want to accept that job or pass on it. So we have Wyoming Wire. They make barbed wire, and it says we presently have a capacity of 100,000 tons of wire per year, and we're operating at 80% of annual capacity. That's a key because that tells us that we have a little extra capacity to do a special order. If we were operating at 100% capacity, we'd probably have to incur extra cost if we were going to take on another order. So at that level operation, the cost per ton of wire is right there, and we've got direct material, direct labor, and fixed overhead. We would consider every one of those costs to be variable. We're given one number for fixed overhead. We consider that to be fixed. The average sales price is $900 per ton. State of Texas has approached us to supply 200 tons of wire for $670 per ton, so it's a little bit of a discount from what we normally sell it for. It says no production modifications would be necessary to fulfill the order from the state of Texas. So first of all, we need to point out what the relevant cost would be. The only relevant cost would be our variable cost of $560 and the $40 and the $50. It gives us a total of $650. That is the total amount of relevant cost. And you say, well, wait a second, what about the $190? That $190 is not relevant because we would incur that anyhow. Whether or not we accept this order, our fixed overhead is still $190 since we are below capacity. So that is an irrelevant number. I'm going to put right down here an incremental cost of $650 per ton. The problem says that the state of Texas is willing to pay us $670 per ton. So if we look and we're talking about an incremental revenue of $670, incremental cost of $650, the $20 difference per ton would be an incremental profit. Based on that, we should accept the job, because the $20 per ton profit multiplied by how many tons I needed, 200, would give us a $4,000 incremental profit. Normally, we would base our decision on the amount of profit that we would make. In this case, since we got a profit, we go ahead and accept the order. Sometimes we may accept an order at a slight loss if it means maybe we could develop a business relationship and kind of get our foot in the door. Now, obviously, we want to make a habit of doing that, but it is something to consider. But most of the time, if we're talking about accepting a special order, we want to make sure we're making a profit on that order. Well, that's how we do our various relevant decisions here. If you have any questions as you're going through the homework, let me know and we'll try to help you out.